Welcome to the Explainer. With the markets being so unpredictable lately, you might be asking yourself, is there a way to make my savings grow without all that risk? Well, today we're going to talk about a classic financial tool that's making a huge comeback. So let's just get right to it with a tough question. Is your savings account actually losing money? Yeah, the number on your statement might be inching up, but here's the thing. Inflation is probably eating away at its value much faster. It's like you're taking one step forward, but inflation is pushing you two steps back. Your money just doesn't buy what it used to. All right, let's talk about the CD's big comeback. The good news is there's a real solution here. You see, because interest rates have been on the rise, the certificate of deposit, the CD, is suddenly back in the spotlight. It's not just for your grandparents anymore. It's become a seriously powerful tool for getting a safe and, more importantly, a guaranteed return on your cash. So what in the world is a CD? Well, the easiest way to think about it is like a financial time capsule. You're basically making a deal with your bank. You say, hey, I'm going to let you hold on to this chunk of my money for a set amount of time, and I promise not to touch it. And in exchange for that promise, the bank gives you a much better, totally fixed interest rate. You lock it in, and when that time is up, you get your money back, plus all that sweet, guaranteed interest. And the whole process, it's incredibly straightforward. Step 1, you make a one-time lump sum deposit. Just put the money in. Step 2, you pick your term. You decide how long you want to lock it away. Maybe it's 6 months, maybe it's a year, maybe even 5 years. It's totally up to your goals. And step 3, you just wait. When the CD matures, as they call it, you get to withdraw all your original money plus all the interest it earned. Simple as that.
Okay, so what's the catch? Well, it all comes down to a really simple trade-off. Let's call it yield versus access. The deal.
So here's the deal in a nutshell. With a regular savings account, you get total access. You can pull your money out whenever you want, no questions asked. The downside? The interest rate is usually pretty low, and it can change at any time. A CD is the exact opposite. You agree to give up that easy access, and in return, you get a much, much higher interest rate that's locked in and guaranteed. You're trading flexibility for a bigger, predictable return.
You might be wondering, why are banks so willing to pay you more for a CD? Well, it's all about predictability for them. When you lock your money in a CD, the bank knows for a fact that they can count on having that money for a specific amount of time. That makes it a really stable source of funding for them to use for other things, like giving out long-term loans. So that higher interest rate, that's basically your reward for giving them that peace of mind.
All right, so CDs are one of the safest places you can put your money for sure. But, no investment is totally risk-free. So let's pop the hood and take a look at a few things you absolutely need to be aware of. First, let's talk about the ultimate safety net, federal insurance. This is huge. Whether your CD is with a bank or a credit union, it's almost always protected by the government, either the FDIC for banks or the NCUA for credit unions. This is your guarantee that even if the institution were to fail, which is super rare, your money is safe. And how much is it insured for? A cool $250,000. And that's per depositor per insured institution. What's really neat is that this coverage is also per ownership category. So for example, you could have an individual account and a joint account at the same bank, and both could be insured up to that $250,000 limit. It gives you a lot of coverage.
Okay, so the biggest risk with a CD isn't that the bank will go under. Honestly, the biggest risk is you. It's you needing that money before the term is up. Because if you break that time capsule agreement early, there is a price to pay. It's called the early withdrawal penalty.
And this is something you have to take seriously. Look at this quote from one of our sources. In some cases, the penalty can be so big that it wipes out all the interest you've earned and can even dip into your original investment. Yeah, you heard that right. You could actually lose some of the money you first put in. So you've got to be sure you won't need that cash.
Beyond that main penalty, there are a few other kind of invisible risks to think about.
First, there's inflation risk. What if your locked-in rate doesn't keep up with rising prices? Your money is growing, but its buying power is shrinking. Then there's opportunity cost. What if you lock in a rate and then rates go even higher? You've missed out. And finally, reinvestment risk. When your CD matures, what if rates have tanked? You'll have to settle for a much lower return next time. Okay, but the good news is CDs come in more than just one flavor. they aren't a one-size-fits-all product. So let's check out some of the different types you can get.
You've got your traditional CD, right? That's your standard, no frills, locked-in rate. Super predictable. Then there's the no-penalty CD. This one's pretty cool. It lets you pull your money out early without getting hit with a penalty. The trade-off is usually a slightly lower interest rate. But hey, you get flexibility. A bump-up CD is great if you think rates are going to keep rising. It gives you the option, usually once, to bump up your rate to the bank's new, higher rate. And finally, there's the callable CD. This one's a bit different. The bank has the option to end the CD early. They pay you a higher rate for that risk, but it's definitely for the more advanced savers. All right, this is the part you've been waiting for. Let's talk actual numbers. What are the best rates you can get right now? Here are August 2025's top rates.
Okay, take a look at these. The rates are really strong. For a shorter 6-month term, Morgan Stanley Private Bank is offering a fantastic 4.45% APY. And get this, with zero minimum deposit. For the classic 1-year term, Limelight Bank is at a very solid 4.4%. And if you're willing to go long-term, for 5 years, Popular Direct is offering 4.2%, though you do need a $10,000 minimum deposit for that one.
Now, just to put this in perspective, look at this comparison. It is wild. That top 1-year CD rate of 4.40% versus the average savings account rate, which is just 0.75%. I mean, it's not even a contest. You're earning almost 6 times more money on the exact same savings. The only difference is where you put it. That's a huge advantage. So if you take away just one tip for shopping around, let it be this one. This is the golden rule. Always, always compare CDs using the APY. That stands for annual percentage yield. Why? Because the APY already factors in compounding interest. It's the true all-in number that tells you exactly what you'll earn over a year. It's the only way to do a real apples-to-apples comparison. Okay, before we wrap up, I want to share one last thing. This is a real pro-level strategy that kind of solves that whole yield versus access problem we talked about. It's a way to get those awesome high yields while still having regular access to your cash. It's called CD laddering, and honestly, it's brilliant. Here's how you build one. It's easier than it sounds. First, you take the total amount of money you want to invest, and you divide it into equal chunks. Let's say you have $15,000, so you make 3 chunks of $5,000. Next, you buy CDs with staggered terms. So you put one chunk into a 1-year CD, the next into a 2-year CD, and the third into a 3-year CD. See? You're building the rungs of your ladder. Now here's the magic. After 1 year, your first CD matures. You can take that cash out if you need it, or, and this is how you keep the ladder going, you reinvest it into a new 3-year CD. Now you have a chunk of money becoming available every single year, all while earning those higher, longer-term rates. It's the best of both worlds. So there you have it. You know what CDs are, you know the risks, you've seen the top rates, and you've even got a pro strategy like laddering in your back pocket. So that really just leaves one question for you to think about. What's the first step you're going to take to make your savings start working for you? Thanks for joining us on The Explainer.